So how much income tax will you pay on dividends that you take out of a limited company? Well, the answer is in this video, so go check it out. Hi everyone, my name is Simon Rishevich from Optimize Accountants, and today's video we're going to be talking about tax. We do that all the time actually, but let's talk about income tax on the dividends that you pay out. Now, we've got to think about what is a dividend. A dividend out of a limited company is post-tax profits. Okay, so you have a profit, you pay tax to the HMRC, corporation tax we talk about here, and then the money remaining is going to be dividends that you pay yourself. Now, there are ways of taking money out of a limited company, and you might watch this video and say, well, actually, paying myself a dividend isn't as tax efficient as one was led to believe. So how else can I take money out? Well, most accountants will tell you about wages that you could pay yourself, dividends, of course, we've just talked about, but also interest that you could charge to the limited company on any money you've loaned to it. There are many other ways, so make sure you get some good tax advice on that. And whilst we're talking about tax advice, you can get some tax advice from us. So use the QR code or the link in the video description box below. So let's talk about income tax then on dividends and really how much you could be paying. And what I want to do is do this in three different blocks. There's the 6th of April 2016, then there's the 6th of April 2018 and 6th of April 2023. And if you do different actions on those time periods, then something else is going to happen. So tax-free amounts. The first box is £5,000. Can you remember where you could take out £5,000 worth of tax-free dividends? Well, not many people could because it was short-lived. But then in April, 6th of April 2018, if you took out the same amount of dividends, you would have been taxed on the 3,000 because only 2,000 would have been tax-free. Things change again. 6th of April 2023, £1,000 worth of tax-free dividends can be taken, nothing more. So HMRC really are pinning you down, and the argument could be is, will there be a tax-free element at all? Who knows? Now, let's think about basic rate taxpayers. Not only is the tax-free element changing, but look at the first two boxes. They are the same in terms of rates. But from 6th of April 2023, the amount of income tax that you'll be paying on your dividends is increasing, disappointingly. So 7.5% is moving up to 8.75% for basic rate taxpayers. High rate taxpayers, you'll be paying, instead of 32.5%, you'll be paying 33.75%. Who comes up with these numbers? An additional rate taxpayer, 38.1%, weird number, moves up to 39.35%. Again, significant amounts of taxation if you're an additional rate taxpayer. What I want to do, though, is show you the total tax that you'll be paying as someone who owns a limited company compared to self-assessment. Now, I always think that's worth it. Now, I'm looking at landlords, so if you're self-employed, you might need to think about national insurance, but I'm focusing on landlords, and that's what my business is all about. So what taxes do we have here? So we've got three boxes again, same 6th of April 2016, 6th of April 2018, 6th of April 2023. And you will see the previous, I talked about basic rate taxpayers here. So 7.5% of income tax that you pay on your dividend, plus your corporation tax of 19%, is a total tax of 26.5%, which is more than the self-assessment tax band of 20%. Now, you think, well, why should I use a limited company? And there's many good reasons for you to use a limited company. I say that most landlords still should use a limited company for their investments, and there's probably going to be lots of people countering that, and that's absolutely fine. It comes down to opinion at the end of the day. From the 6th of April 2023, the basic rate tax band will be paying 8.75%, plus the corporation tax is changing as well. The highest amount of corporation tax that you could be paying is 26.5% as an effective tax rate, which basically means that you're going from 26.5% all the way up to 35.25%, which is an amazing amount of tax difference. Amazing is probably not the right word. What word would you use? Please, in the video description box below. Keep it clean though, if you don't mind. So yes, look again, this is someone who is a basic rate taxpayer and yet is paying up to 35.25%. They could have kept it at 20% using self-assessment tax returns, but again, I'm going to prove why that's not true. High rate taxpayers, this is even more shocking. Again, please do tell me your comments box below how you feel about this, because I look at these numbers and I think 60% tax, really, in this country? No, that's crazy. So again, let's just look at high rate taxpayers taking money out of the limited company in the form of dividends is paying 32.5%, but that's increasing to 33.75%. Now, corporation tax, as we mentioned, is going up to 26.5% of the effective tax rate. That means that totaling those up is 60.25%, which is 20.25% more than you would pay on your tax return, self-assessment tax return, which is crazy. And again, you're thinking, well, should I use just my own name? Forget this. In terms of using limited companies, don't. There's good reasons for that. And finally, what I'm going to focus on is Section 24, the mortgage interest relief cap. We know that high rate taxpayers, so I'm going to focus on high rate taxpayers here. Let's imagine that you have rental income. Now this is comparing 2 different years. It's just random. I just want to create two different time periods. 6th of April 2013 against 6th of April 2023. £50,000 worth of rental income, same. Mortgage interest, 30,000, same. Taxable profits, 20,000, but 50,000. Huh? Wait a minute, I can't do my sums. No, it's true. Taxable profits from the eyes of HMRC will ignore mortgage interest costs because of Section 24. It's mortgage interest relief cap, which basically means they give you 20% tax reducer on the mortgage interest cost, not the tax cost reduction against your profits. So therefore, if you look at this in isolation, in April 2013, you pay £8,000 worth of tax to HMRC, which is 40%, which you know that because it's a higher tax band. But in April 2023, that same person with the same profits, the same properties, would indeed pay £14,000, which is £20,000 tax, less the tax relief of £6,000. £14,000 equates to 70%. Now, when people saw on the previous screen that the amount of tax is 60%, is crazy. Why would you use a limited company? Well, you would do it because of Section 24. You can offset your mortgage interest costs against your limited company. You cannot do the same in your own personal name. And we also got to think about, well, actually, you don't have to extract all of that money out of the limited company. You could use it to reinvest in the company. You're only going to be taxed on dividend income tax if you take the money out. But if you leave it to reinvest, it isn't going to be taxed in your name. And there are so many ways of reducing income tax, capital gains tax, inheritance tax by using limited companies, moreover, than you can in your own name. So it's worth you getting some tax advice with your advisors and finding out what you can do all about it.